Sunil Tirumalai wrote this note on 5th of August, and now some water has passed underneath the bridge, particularly because the BOJ has sounded a slightly more dovish tone today. He's the chief GEM strategist, general emerging market strategist, equity strategist at UBS, joins us right now on the show with his thoughts. Sunil, great having you. Thanks for taking the time out. Your note suggested and spoke about the August meltdown and beyond. Does that beyond change a little bit now that one of the central bankers has come out and sounded a bit more dovish or has tried to soothe some frayed nerves?
Hi, good morning, Neeraj, and good morning to all the viewers. Yes, so I think when we saw the meltdown late last week or early this week, there were a bunch of global macro factors that were all colluding at the same time, right? And as you rightly pointed out, there was a out of turn surprise rate hike by the Bank of Japan, that kind of caught the market unawares, and then with that the whole story of the yen carry trade unwinding. We had the U.S. Recession fears come back after a poor jobs data. We had a couple of weeks of fairly mixed big tech earnings in the US. And, as you know, a decent part of the global equities and the Asia equities rally has been driven by the AI theme. And of course, not yet fully resolved is the escalating, worries of conflict in the Middle East. Now, you're right. So this morning, the BOJ comments have been to soothe the nerves of the markets. But at the outset, our team, the economics team in Japan, still believes that the path is for slow and steady rate increases and normalization of the monetary policy in Japan. They are still, talking about a total of about 25 to 50 basis points increase by the end of this year. So I think what the comments this morning tried to do was to respond to very sharp market reactions both in Japan and elsewhere. Specific to the carry trade, some of the numbers done by our Japanese strategy team suggest that we're probably about 75% done with the unwinding, which means that 25% is still to go. And as long as the path for the rest of the world is towards lower rates, and the path for Japan is for higher rates, I think that should continue. So we still have probably a quarter of the unwind to happen, which probably means it does affect assets globally, across US emerging markets, etc.
Sunil, I'm going to come in on that because that was a very interesting point. 75% of the Japanese carry trade unwinding is now behind us, in your opinion. Do you feel, so part A, do you feel like the rest of the 25% will be almost immediate, maybe one-off, sharp, painful, but will be behind us? And secondly, of course, this is only a theory that I'm talking to you about. Do you feel like that the Fed now will take its time in cutting rates in order to ease the impact of this Japanese carry trade unwinding? Maybe the need of the hour, but it's not going to be good for risk assets. Is that something that could, be collateral damage, if I may say, of what happened to the Japanese carry trade?
Okay, so looking at the first question, so this unwind of 75% is something that's probably been happening for the last 2 to 3 weeks, right? And actually, it's about a month of unwind that's been happening. And I think you could probably say it's another week to 10 days at the similar pace. As I said, we wouldn't read the BOJ's comments as moving away from a path of normalization drastically. It is probably saying, we'll wait and watch for some time, but our house view is that the normalization path is set. As far as the US Fed is concerned, I think their mandate doesn't necessarily look at Japanese economy or exchange rates or even asset prices to a large extent. I mean, they look at inflation and economy and the growth primarily through the jobs data, right? I think the chatter around a sharper Fed rate cut came up because of a poor jobs data last week. And I think that's something which is kind of an adulterated number because we had disruptions due to the hurricane, and there was some planned maintenance and shutdowns in some of the auto industries, etc. So overall, uh, our economics team does not factor in. There is a slowdown coming, but it's probably not a hard recession. But the market seems to have gone to the other extreme and started pricing in even 100 basis points of Fed cut by end of this year. If you look at the OIS markets, I don't necessarily think the Japan yen carry trade is on top of mind for the Fed when they are looking at the rates decision. I mean, we have genuinely seen softening data in the US. We've been seeing mixed data for a long time. It was generally positively biased towards strength in the economy till about 3 to 4 months ago. But since then, we've actually been seeing reasonable weakish bias in the US economy data, including many of the companies, corporates coming out and saying they're missing their numbers, they're seeing weak and sagging sales growth, etc. And of course, you also had weaker ISM manufacturing, you had a weaker jobs data. So I think all of that basically also led to the Fed basically saying that a cut is coming most likely in September. We still are in line with what the Fed's comments is. I think the market has gone slightly ahead on that. But just to answer your question, I don't think the carry trade is directly something that would play on Fed's minds.
Absolutely, Sunil. Just to take that forward, the carry trade may not be on the Fed's mind, but economic data definitely will. And now this entire question that the Fed may have been a little too late to look at rate cuts. We'll have to go deeper in September. I'm just wondering if you subscribe to it at all.
So UBS has been, kind of cautious and below the street as far as the US economy outlook has been concerned. And yes, I think we do have some sympathy for the view that there is meaningful amount of rate cuts coming. But I doubt we are really looking at what the bond markets are telling us, what the rates markets are telling us, which is about 110 basis points by end of this year. It may not be as steep. So we are talking about 25 basis points in September, and probably one more round by end of the year. And primarily because the latest jobs print was affected by various extraneous factors, and that could be seen as a one-off by the Fed as well. So yeah, I think that's how we would look at it.
Sunil, what's the view therefore on what emerging markets could do in the event of a rate cut cycle starting? The extent notwithstanding, let's assume the cycle starts. Whether you are right or the street is right is separate, and only the Fed can answer that. But what happens as a result of that to GMs?
So historically, there have been a few rate cut cycles that we can kind of look back upon and see, what could happen. And each of them had their own context in terms of what the macro setting was. Traditionally, what we see is that, on an average, EM equities tend to go up by about 1-2.5% in the 6 months after the first rate cut of the Fed. But if that rate cut is also around a recession, or is followed by a recession, or it's because of an impending recession, then you actually see a meaningful downside of about 3 to 4%, right? So that's not a very encouraging setup if we are actually talking about a slowdown coming up. I think on an absolute basis, this is true for most equity assets, except for China, where we see very different set of parameters playing out. But it's true in the US, it's true in India and it's true in most of larger emerging markets. The equities seem to be already priced. Equities valuations are already pricing in a meaningful support from the bond market, but the earnings are not, factoring in any impact from a slowdown, from a global economic slowdown, right? So the earnings expectations are still fairly elevated. If I look at emerging markets, you're talking about 16, 18% CAGR for the next 2 years. Heavily concentrated in tech and AI theme. They could deliver, right? And I think that's something which our tech team genuinely believes that those are numbers that can be delivered. But if there is any risk of a slowdown in the US, those are downside risks that are probably not yet priced in. So the absolute story for EM is still kind of not fully clear, but the relative story, I think it's becoming pretty interesting, especially because EMs have underperformed a lot more than the DMs, and the earnings risk from a US slowdown is more for DMs than for EMs.
Right. Sunil, taking a cue from what you just said, we completely agree. We've borrowed returns from the future. The markets have had a phenomenal dream run in the last few years. What does an investor do? So in terms of actionables, if there is a downside risk from where we stand, should investors who've made money take profits off the table and do a little bit of portfolio rebalancing where you move away from equities into safe assets? Or would you continue running your portfolio? Or third, maybe incrementally keep adding, because the only way to create significant long-term wealth is to keep adding to the markets at every fall and at every rise.
Okay, so we normally work with a 12-month view when we give advice to our clients and investors. I'm assuming your question is specific to India. So we've had a fantastic run, and even YTD, India is one of the best performing markets globally. And if you actually think about it, it's largely flows driven. I gave you the number of about 16 to 18% for whole of emerging markets growth for the next 2 to 3 years. The similar number for India is about 12 to 13%. I'm just talking about consensus. And even if I look at the historical 3 to 4 years, the growth delivered by India is not very different from other emerging markets, right? So the outperformance of India has primarily been, it's primarily been a function of valuations expansion. And as you know, this year there hasn't been very strong participation by foreign money. It's basically domestic money, right? So it's basically domestic equity flows that have been really strong and have supported the market, and and taken through multiple macro and political events all through this year. Going forward, for a foreign investor, this is something which is very clearly already visible in the numbers. Allocating money additionally to India in the portfolios is a bit of a challenge given where the valuations are. And as we see, for an active investor, either an Asia investor or an EM investor, they are down to neutral on India from what was essentially a 4 to 5% overweight position 5 to 6 years ago. So they've consistently been reducing their active weight on India. And if the entire universe that we track is down to neutral, it's possible that many of them are become underweight too, right? So I think we completely sympathize with that view, because for the kind of growth that we're getting from Indian corporates, the valuations appear fairly rich, right? But when we're looking at a domestic investor base and and retail flows, I think there is momentum. I think all the numbers that we see in terms of SIP inflows, those are really helpful in supporting the markets. But you do get a feeling when earnings yields are extremely low, and compared to bond yields are like a 25-year low, you're already pricing in enough of benefits from the bond markets, and if there are any rate cuts, etc. So in that context, at a time when the nominal GDP growth for the country, for the economy, is probably the slowest in the last 14, 15 years. You have a bank credit growth, which is slowing. Some of the larger consumer stocks aren't giving you more than 8-10% top line growth. It's primarily a lot of the excitement was around the government-driven infrastructure businesses, and that is still growing. But we know that the government capex spend is also, the growth is also off from its peak, right? So in that context, yes. So I mean, we would feel that. So we have currently India as an underweight in our emerging markets, ratings universe. And for investors within India, I think it probably makes sense to look at other asset classes, including fixed income, where you're actually getting probably better yields and better returns. And if in all likelihood, whenever there is a rally in bonds for whatever reason, whether it's because of global reasons or local reasons, we're not sure if that will immediately translate into equities, because a lot of that has already got priced in.
Sunil, what changes that? And very, I think, elaborate and clear explanation about why foreign investors may not look at India the same way. You're saying UBS is also underweight India because of valuations, corporate earnings are not keeping up. What changes that? Because we've seen this as a market, at least domestically, which has ignored the valuations problem for a while.
Yes. So there could be two things that could change, right? So one could be on the top, or one could be at the bottom. So when I say from the bottom, companies suddenly start reporting very strong numbers. I'm not sure if those things change very quickly. And at least even if we look at some of the commentary by companies, I don't think the capex plans are really going up in a big way. And we aren't seeing many pockets of acceleration of growth. What we've always held is that if you look at the economics around the savings of how households have been behaving, we're going through probably one of the lowest levels of household financial savings in India today, right? And it's the lowest in about at least in our numbers, it is 25 years low. And some numbers that we've seen coming from RBI probably is even longer. So we are going through fairly low levels of savings, and when I say low levels of savings, the gross savings are lower and borrowings are more. So households are saving less, borrowing more, and they're either consuming or probably investing into the markets. But the savings, gross savings that's happening, it is low, and within that, the allocation towards risk assets like equities has been high, and it's been going up. This probably means I think this is a very important problem for the policymakers. I mean, for a country of India's level of evolution, where investments are big investments, infrastructure, etc., are ahead of us, it's important we have domestic savings fairly high, which is what China went through when they were doing their investments. But if you're having very low savings, it is something that needs to be fixed, right? It's possible that one of the reasons behind low savings and an affinity for markets is that the population perceives the real rates to be too low, right? I mean, you won't get it by looking at a bank deposit rate and the CPI, because the CPI may not be representative of what is the real inflation for a saving household, which probably is at the top 20-25% of the income pyramid. So if the solution is to fix the real interest rates in the economy, that either has to come from a reasonable fall in inflation, or it has to be through higher nominal rates, right? I think the corollary of that is what is being faced by the problems by the banks in terms of lower LDR, very high LDR levels, and I think. I think so the way I see the link playing out is that if the deposit rates for the banks continue to harden, they start becoming more attractive, and hence households find other forms of investments more attractive than markets.
Well, let's see if that uptick in deposit rates indeed makes them more attractive than markets. The last 4 years, that hasn't been the case, Sunil. Let's see how it shapes up. But it's an important point. Thank you so much for laying it out all for us and for giving us your time today.